Well, good evening, and a very warm welcome in every sense of that term to you all. For those of you who don't know me, I'm Professor Tom Poole, and General Editor of the Modern Law Review, and I'm absolutely delighted to welcome you all to the LSE and to this year's Chorley Lecture. Now, aficionados of this event will have noticed that we're in the wrong room. Normally we're upstairs in the Shaw Library, that strange, slightly otherworldly shrine to George Bernard Shaw and the school's other Fabian founders, Beatrice and Sidney Webb. They're doing major renovations at the moment to that room, hence we find ourselves in a different but equally freighted space, the old theatre. For those of you who don't know, this was the place where Friedrich Hayek took on Keynes on economics and freedom, where Michael Oakeshott and Harold Lasky, the leading conservative and socialist thinkers respectively of their era, took on each other and the world. So no pressure. But a bit closer to home, this would have been the theatre in which Robert Chorley, later Lord Chorley, the MLR's general editor, at its inception in 1937 and for the next 3+ decades, would have given his lectures in commercial law. So it seems particularly apposite, given his areas of interest, then to welcome this evening's speaker, Professor Chris Brummer. Chris is Professor of Financial Technology at Georgetown, where he's also Director of the Institute of International Economic Law. He lectures, publishes widely on fintech, financial regulation, and global governance. His public service, volunteer, and public advisory engagements are legion. So can we please give a warm welcome to Chris, and the topic of his Chorley lecture this evening is regulatory agencies in the inclusion trilemma. Chris, thank you very much.
Thank you. Thank you. It is such a pleasure to see so many of my friends, my colleagues, intellectual fellow journeymen and women. It is just a pleasure to be here, to be back at the London School of Economics. I had the opportunity to spend several weeks here as well on campus. Thank you to the Modern Law Review and for everyone for showing up. Certainly, when you're sitting by for a lecture and I was told that you have to speak for 50 minutes, I said my own wife would not listen to me for 50 minutes, but I'll try my best. And when then also told that here, and now that I understand a bit more the tradition of this event, that there would be no PowerPoints, so maybe around the 20-minute mark, if I resort to sock puppets to describe particularly issues like a trilemma, you'll have to indulge me. But I did want to thank everyone, my good friend David Shaw, and I should say the dean of the school. Wonderful choice. Good for taking it on. Okay, I guess I will just launch right into it now that I've used up one of the 49 minutes. To talk about my paper, my idea. As many of you may or may not know, I really do spend a lot of time talking to financial regulators and to industry. I just spent some time earlier today talking to the chief data scientist over at the Financial Conduct Authority and some time over at HMT. And when I was trying to think about my role in Washington, I say I'm increasingly a psychologist of sorts. Regulators will from time to time complain about issues that they have in financial regulatory issues and would look to commiserate, and industry, I guess, does the same. And that I have my own interests in many of these issues, particularly when you're thinking about the intersection of financial technology, innovation, and regulatory regimes. It's my belief that innovation is not just a catalyst for change in markets, but they are also catalysts for changes in the administrative state. It's something that we're grappling with in the United States, and something that all administrative agencies and regulatory agencies are grappling with all over the world. At the same time, there are some long-standing values that persist. And the question is, how exactly do regulatory agencies balance these values, often competing values, in a world where change happens in not just days or seconds, but milliseconds. Now, financial regulation is often discussed and debated in terms of absolutes, but in reality, the field of financial regulation is inherently a game of trade-offs. Policies aimed at preserving wealth might work well for older people who have life savings piled up, but they may not enable investing opportunities for the young. Meanwhile, rules designed to ensure well-capitalized financial institutions might have positive implications for financial stability, but also exacerbate inequalities related to the access historically marginalized groups may have to capital. AML and KYC rules, those know your customer rules, may be necessary for fighting money laundering, but may hamper launching and growing new or growing banks or enabling remittances, and so on. The invariability of trade-offs in financial regulation explains in part the ideological fervor that can animate supporters and detractors of any particular reform or rule. Ultimately, even technocratic decisions often involve a normative presumption or a priority, or a particular goal or a balancing of different kinds of priorities. Thus, the pursuit of a rule can take on a normative and highly ideological valence. The attempt to achieve a particular goal tells you not only what a regulatory agency wants to do, but it can also tell you what it is willing not to do, or at least the order of its preferences when pursuing any number of goals. It also demonstrates what an agency is worth risking not happening. Rules, in short, express agency priorities and can create winners and losers in more ways than one. Still, trade-offs in financial regulation, like those of economic policy, are rarely bilateral and zero-sum. Instead, they spill over across multiple issue areas. A decision to pursue X can create trade-offs for agency aspirations to pursue Y and Z. That's the most math that we'll be using today. Or the pursuit of both A and B, though not necessarily the pursuit of either in isolation, may create trade-offs for achieving objective C. For regulators pursuing multiple objectives, and that's really most administrative agencies, this reality complicates, or at least should add nuance to policy conversations, and the best regulators will take the time to consider what prophylactic steps or mitigation policies should be undertaken to optimize realizing as many agency goals as possible. Now, this conversation today introduces one of, at least for me, the more consequential set of trade-offs, especially as an American living in the post-George Floyd and post-pandemic economy. What we'll be talking about today is a set of trade-offs where financial regulation can be bound by what can be understood as an uncomfortable social policy trilemma. Specifically, when faced with providing market integrity, fostering innovation, and enabling financial inclusion, regulators have long been able to achieve, at best, only two of these three goals at any one time. Now, addressing this challenge, one that has been for far too long ignored in the academy and amongst regulators, will require rethinking the legal and bureaucratic infrastructure supporting agency action. So my comments today will sort of take on two parts, maybe a mid-time stretch around that 25-minute mark for those of you dozing off. At least for the first sort of iteration of my comments today, we're going to sort of walk through some definitions and sort of come to understand exactly what each of these sort of core concepts mean. And after walking through those definitions, we're going to walk through a couple of case studies. It's not necessarily a historic walk through time, in part because one of those categories, that of financial inclusion, doesn't necessarily have the longest of histories. But we will at least walk through different kinds of categories involving early stage investment, sort of like in how do you invest in early stage companies, the 2008 financial crisis, and the payments sector, and use those case studies to highlight how integrity, inclusion, and innovation collectively stand in tension with one another as regulatory priorities. Then, for those who are still awake, I'm going to walk through how exactly one can begin to optimize or to think through solving this trilemma. And we'll also sort of ask ourselves what exactly solving a trilemma even means in the first place. Against this backdrop, I'm going to introduce or suggest, and this is something that the UK has quite a bit of experience in, a little bit less so in the United States, to sort of think about what regulatory mandates mean. How hard is it to rethink regulatory mandates, and the challenges presented by elevating certain kinds of long overdue or ignored preferences into those agency mandates. Then it will evaluate, our conversation will evaluate upgrades to administrative practice and to sort of walk through a couple of suggestions as to how regulatory agencies can again optimize different preferences like financial inclusion that are coming to the fore in a world of technological change. Now, by making these kinds of comments, by offering a bit of a kaleidoscope of different case studies as well as a coherent theory, what I'm really hoping to do with this contribution to the journal is to really think through a more holistic understanding of the difficult task set before regulators seeking to pursue 20th century priorities of market integrity while accommodating and realizing 21st century priorities like innovation and financial inclusion. In that way, hopefully, for those who really make it to the end, we can have a bit more of an appreciation and understanding of both the flexibility and constraints of legal mandates and administrative architecture and what they afford regulatory staff and leadership in their problem solving. All right. That's it, now you can go. Normally I'd ask for questions. All right, so typically scholars tend to look at the goals of regulatory missions as lying embedded in their formal legal mandates. We're all sort of lawyers here, and we understand the importance of words and the importance of nominations. In many instances, they tend to revolve around practices like market integrity, financial stability, competition, capital formation, or the fostering of financial products to meet certain industry needs, like hedging or housing. Right? In practice, however, regulators may respond to a broad array of pressures and expectations, and they have an interest in securing any number of formal and informal outcomes. It is not to say that informal and formal mandates necessarily carry the same legal consequences for agencies as they pursue them, but it is significant that agencies try to do several things at once, whether by law or due to new social demands or expectations. And it's hard to chew gum and walk at the same time. Now, in an earlier article that I did with Yesha Yadav, a professor over at Vanderbilt, called Innovation and the Fintech Trilemma, we had emphasized the challenges of navigating a different kind of, but a cousin to this particular challenge, of navigating the problems or the challenges or the goals of market integrity and traditional preoccupation of regulators when combined with pursuing innovation and rules clarity. Right? So that the challenge of both making clear rules, achieving market integrity, and also aspiring for some kind of financial innovation. But today I want to introduce, again, a more timely social trilemma and the trade-offs that emerge when regulators seek to pursue market integrity, innovation, and a new factor, financial inclusion. And again, just so that we understand where I'm heading, again, when regulators seek to achieve market integrity and innovation, my argument is they usually must sacrifice financial inclusion. On the other hand, when they seek to maximize financial inclusion and market integrity, innovation is often on the chopping block. And when authorities seek to optimize financial inclusion and innovation, market integrity is often afforded short shrift. And that is the closest thing that I'll get to economics today in terms of the concept of a trilemma and how it often pervades lots of different economic theories. Now, as with any trilemma, definitions are important. Regulators have many mandates, and those mandates can themselves carry a variety of meanings and interpretations. So in order to ensure that the trilemma is properly understood today, let's walk through some of those definitions. Now, market integrity is something that I've worked with in Washington, and certainly innovation is often used as a bit of a catchphrase. But for conceptual clarity, a little bit of extra work is required. Now, perhaps among all aspirations of financial regulators, perhaps market integrity is the most intuitive goal. Financial regulators are the proverbial cops on the block. One aspect of this remit includes combating fraud and making sure that consumers of financial services are protected from unfair and illegal acts that could deprive them of money, their rights, or both. This means that the integrity of markets relies on ensuring not only transparency, but also the safety and soundness of institutions through which capital flows. Now, market integrity is understood as emanating from the need to ensure that markets operate fairly and safely in order to encourage the widest possible confidence in them. Just today with the FCA, the word trust was probably the most common word uttered in my conversation. And by enabling confidence, enabling trust, you're able to promote economic transactions, high levels of savings, investment, and more. And if you don't have market integrity, you catalyze everything from bank runs to underinvestment. So as such, market integrity encompasses a number of important regulatory features. Robust disclosure regimes comprise an essential layer of protection, both in enabling market discipline and regulatory scrutiny and oversight. Correspondingly, strong anti-fraud protections supplement basic disclosure requirements and discourage backed actors from exploiting others. Public regulation also looks to issues like the safety and soundness of institutions and undertakes measures to prevent undercapitalized and under-resourced firms from endangering the stability of markets. All the while, enforcement provides a credible threat of punishment when rules are ignored. Now, I define innovation as the process of creating new financial or investment products, services, or processes. Now, in contrast to market integrity, innovation is rarely, if ever, a formal mandate of regulatory agencies. It is instead, at best, a derivative norm arising from the pursuit of other objectives. Nevertheless, it is often a top priority for many regulators and policymakers. While ultimately a neutral force within the financial system, one capable of enabling prosperity and fragility, at its best, financial innovation can spur growth and competition in financial markets and provide new and better options for customers. It can also serve as the mechanism through which more transparency is generated, as well as the tools for critical market functions like hedging, detecting fraud, and lending with greater efficiency to capital markets with less discrimination. Consequently, many regulators around the world seek, among other things, to prize innovation and seek to create a regulatory environment that cultivates the development of novel, competitive, especially in a world of increasing scrutiny of monopoly power, and socially beneficial financial practices. Now, the final leg of our little trilemma, if I had PowerPoint, I'd have this very nice, beautiful triangle with like little words. And but again, I'm very close to resorting to sock puppets. This final leg is that of financial inclusion, right? Which we will define as the availability of financial tools and opportunities enabling people to participate in financial services and the financial services marketplace. As such, financial inclusion touches on a wide swath of activities, again, from lending and the provisioning of bank deposit accounts to the availability of low-cost mortgages to investment opportunities. By design, financial inclusion is a statement about both equality and access, and speaks to issues like wealth inequality and racial equity, which, while adjacent to investor and consumer protection, emphasize wealth building rather than risk. Now, notably, financial inclusion is, when compared to financial innovation and market integrity, a rather recent priority in the global conversation on financial regulation. I was thinking to myself, yeah, I mean, you guys have actually done that a little bit better than we have. So in my head, I was because I bore myself talking, I was like, USA. But many emerging markets were, in fact, the early adopters of this idea of financial inclusion. Driven in the 2000s by an interest in moving the global south from an informal to formal economy and addressing the needs of unbanked populations seeking basic financial services. In the USA, by contrast, financial inclusion has not always been the role of financial agencies. Indeed, at the time of their creation, many agencies were, if anything, designed to help facilitate financial facilitate financial exclusion in the form of segregated housing markets. When I talk to my progressive friends in the United States who talk about the zenith of the New Deal, I do remind them that it was a great time for progressive politics, not a really great time for black people living in the 1930s in the United States, and how those same administrative agencies were used to promote everything from redlining and segregated housing markets. And even today, most agencies lack an explicit financial inclusion mandate. Instead, financial inclusion has been mandated indirectly for most agencies in the United States through legislation intended to advance it. Like for you banking regulators, you've probably heard of the Community Reinvestment Act, which is a responsibility amongst the Federal Reserve, the Office of the Comptroller of the Currency, and to the FDIC. And then we have a range of fair lending rules. And as a result, financial inclusion has not been incorporated as an explicit goal or purpose amongst most agencies in the United States, with the notable exception of our housing regulator, the FHFA. Yet even in developed markets, most agencies espouse an interest in advancing financial inclusion. The OCC, for its part, has dedicated programming in the form of something called Project REACH, which stands for the Roundtable for Economic Access and Change, which is designed to address the key barrier to financial inclusion by focusing on the so-called credit invisibles, home ownership, minority banks, and access to capital for ethnic minorities and businesses. You see similar initiatives amongst the Federal Reserve, and even in a capital markets regulator like the SEC, although the SEC has not explicitly embraced inclusion and financial inclusion, the SEC's chairman, Gary Gensler, has observed that financial inclusion is an essential element of its mandate to advance fairness in financial markets. Just as Sheldon Mills, the executive director of the Consumers and Competition, has argued that regulation has an important role to play to further financial inclusion and its policies to advance financial inclusion. So again, the reason why I'm walking through this is when you look at mandates, you have explicit mandates, mandates that are embedded in the administrative state legally. You also have informal mandates. These informal mandates may be either the product of new expectations in society or interpretations of, let's say, first-tier mandates in their application to new and emerging problems in society. And whether or not explicit or implicit, agencies and their leaders have espoused sort of these any range of different objectives for their respective agencies. So the question, of course, comes from how and if one can balance them all. Now again, our trilemma hypothesis arises from this idea that between the three objectives or values highlighted, market integrity, financial inclusion, and financial innovation, that regulators achieve only one, or at best two of the three at any given time. So it's useful to, again, take a little bit of a stroll through some case studies just to highlight the kind of trade-offs and the tensions that can arise. For this paper, and I'm very explicit about it, you kind of have to use case studies to make the point, in part because you don't have a long historical arc, as I did with the other paper with Yesha, to sort of track a different kind of cyclical rulemaking in financial agencies and how they approach competing objectives. The first sort of case study that I want to talk to you about involves early stage investing. Now, one pillar of the trilemma is that if regulators seek to maximize market integrity and financial innovation, they cannot also do so with financial inclusion. And the example I want to bring to bear for you to consider is that of the US Accredited Investor Standard. And I think that the US Accredited Investor Standard offers a really useful example that sort of spells this out in a nice and simple way. If I just took it off and just start spinning. Okay. For decades, the SEC has permitted wealthy people to make private investments, sort of investments in companies that have not gone public and who have not gone through the entire registration process, under the theory that their financial sophistication and ability to sustain the risk of loss of investment, or to quote, fend for themselves, render the protections of basically the 33 and the 34 Acts, or the foundational securities law infrastructure, unnecessary. Right? So basically, if you're rich, you can afford to lose your money. I would not teach that to my students in that way, but for the purposes today, I think it works well. Based in part on the Ralston-Purina Supreme Court case, where the Supreme Court held that, quote, an offering to those who are shown to be able to fend for themselves is a transaction not involving a public offering, the SEC has concluded that, and has engaged in rulemaking, whereby individuals with a certain prescribed amount of net worth in the United States, for those individuals who have made at least $200,000 a year for the past 2 years, or if you're married, $300,000 for the past 2 years as as a married couple, or meet complex specifications that require significant time, money, or both, that those kinds of individuals can invest in private investments that, while carrying more risk and fewer disclosures and protections to investors, could end up being more lucrative. In this particular arrangement, the solicitation of the public is strictly prohibited. And again, one of the wonders and one of the greatest things about particularly this particular financial center and the academy, you know that when you start skipping, because I'll be in payments any second, and so I know that at any one point in time, there's possibly a third of the audience who hasn't followed what I've just said, but they'll know 18,000 things more about whatever I am talking about that they do understand. So, again, and particularly for the students, right, the idea is this accredited investor standard says that if you have enough money, you can fend for yourself. And as a result, you can invest in certain kinds of instruments for which there may not be tons of disclosures and for which the securities laws may not provide the same level of recourse that would be available if, say, you're going to file for a public offering. All right. Now, historically, the accredited investor standard has been interpreted as a choice between market integrity and inclusion, with the former taking clear precedence. By ensuring that individuals who participate can fend for themselves, it establishes the parameters for preserving market integrity by ensuring that those who do participate have the economic means to do so safely, if only through self-help. Technology would, however, ultimately prove to complicate matters in the early 2000s, as the internet revolutionized the ability to reach potential funders and investors in far-flung locales. Following online lending approaches in microfinance that originated in microfinance, a slew of new platforms emerged offering people the opportunity to own an equity stake in startup ventures or to receive interest payments from young companies. These offerings of stock and debt, collectively referred to as securities crowdfunding, provided essential last-line financing for entrepreneurs, especially as small businesses struggled to attract capital and bank loans in the wake of the 2008 financial crisis. When banks weren't lending as much, people wanted to find a capital market solution. However, the ability to leverage online platforms for fundraising was constrained. Soliciting investors for equity or bond-like funding was forbidden unless a company had registered its securities with the SEC, and general solicitation of investors online was not permitted. So in response, industry inclusion advocates argued that changes be made and needed in securities law that would help enable developments in technology to come to market that could help not only democratize investing opportunities, but also facilitate access to new sources of capital for young companies. In response, in the United States, we had something called the Jobs Act, a key piece of legislation enabling securities crowdfunding that amended the rules relating to investor solicitation. While preserving the definition of an accredited investor, those wealth thresholds that I walked through, it removed the prohibition against general solicitation so long as the issuer of a security reasonably believed that the actual purchasers, in the end, were in fact accredited. In that way, issuers could go online, or the radio, or on TV, carrier pigeon, I don't know, and post information about their offering without automatically losing the accredited investor exemption. To the extent to which non-accredited investors participated, their numbers would be limited and constrained to no more than 35, and the non-solicitation ban would apply, limiting the ability to operate online for them. Additionally, however, an alternative regime was created for non-accredited investors to invest in companies up to $1 million, although certain kinds of prudential limits were placed on the amount that any particular investor could invest. So their investments were either capped at 5 or 10% of their income or wealth, depending on their income. Now, all this is to say that from the standpoint of our model, the policy choices collectively represent an attempt to optimize integrity and innovation. Rules were enacted to foster online investing and accompanying innovation. Additionally, rules would bear down on wealth-based metrics for determining accreditation standards for early-stage investors. And while some limited channels would be available to non-accredited investors to participate in deals, usually as the friends and family of the founders, most investors would be largely barred from participating in the most lucrative but risky private deals. Today, the accredited investor standard is criticized as observably exclusionary. Supporters argue that it helps prevent some of the most vulnerable investors from exploitation, thereby fostering market integrity. Critics, however, argue that it redlines U.S. capital markets, making it much more difficult for middle-class people to participate in riskier but potentially lucrative investments. This argument has been particularly salient with minorities in the United States. Whereas the typical white family's net worth is close to $200,000, Latinos have on average around $40,000 of net worth, and Black Americans only $25,000. The accredited investor thresholds thus have a disproportionately exclusionary impact, with only 1.3% of Black Americans and 2.8% of Latinos qualifying, regardless of the innovation in investing that is enabled online. As a result, minorities as well as middle-class people must, for the most part, invest indirectly in early-stage companies through retirement funds or mutual funds, incurring more fees than their wealthy counterparts, or wait for IPOs, which, as we've seen lately, where you have significant value on that front end, and they're sort of fighting over the scraps and pieces, and very often after your IPO, you see the diminishing value of those assets that are investments that are purchased. So again, the solution for the early stage investment is to effectively enable market integrity by allowing people into the market who can fend for themselves. You're also helping to enable financial innovation, because many of these things were geared towards kickstarting financial companies and using new kinds of financial infrastructure. But they were exclusionary because you would largely base access to those markets and to those tools and say, you know, if you're not wealthy, then you can't get in. So that's the system of trade-offs that were made for the early stage investing. All right. Wow, time's flying. Okay, so the second example, which is a little bit easier to understand, and many of you are very, very familiar with it, is the question of housing finance. Now, the intuition behind the accredited investor standard is notably itself not incorrect. Retail investors can be especially vulnerable to exploitation and abuse in financial markets. Financial products are often complex and opaque, making them attractive investments for more sophisticated market actors to take advantage of them. This means that increasingly that complexity and the difficulty of understanding prospective investments can create outsized risks for average investors. In the context of the trilemma, this observation can be described as a dynamic that comes into play where policies can pursue innovation and inclusion, and without taking full consideration of those trade-offs, can lead to market integrity getting a short shrift. Now, the canonical example involves the financial engineering associated with the housing boom in the 2000s. In an attempt to overcome the legacy of redlining in US neighborhoods and the resulting generations-long damage to African American home ownership, the US government decided to expand federal government servicing of low-income and minority borrowers through various affordable housing goals. Introduced as part of a 1992 housing bill, the goals instructed Fannie Mae and Freddie Mac to make 30% of their mortgage purchases affordable housing loans. 4 years later, this quota was raised to 40% and then to 42% in 1997. And in 2000, the Department of Housing and Urban Development ordered the quota raised to 50%. The trend continued during the Bush administration through 2008, when at the time of the financial crisis, the quota had reached 56%. To meet this new quota, there were a range of different kinds of financial innovation that were enabled. Many of you are familiar now with the delectable collateralized debt obligations and CDOs, and other asset-backed securities that would ultimately divide cash flows into different kinds of complex instruments and tranches to appeal to different classes of investors with different tolerances for risk. By ordering the rights to the different kinds of rights to the cash flows, the developers of CDOs and subsequently other securities built on this model were able to convince the credit rating agencies in the United States to assign their highest ratings to the securities in the highest tranche or risk class. Now, these kinds of new innovations enabled Wall Street to do for subprime mortgages what it had already done for conforming mortgages, and they facilitated the boom in subprime lending that occurred after 2000. By channeling funds of institutional investors to support the origination of subprime mortgages, many households previously unable to qualify for mortgage credit became eligible for loans. This new group of eligible borrowers increased housing demand and helped to inflate home prices. So it's very interesting, right? When you compare sort of the policy choices made in the run-up to the 2008 financial crisis, you have a different mix. You're in a different, I don't have the slides, you're at a different point of the trilemma, all right, than you would have been when it comes to the choices, the policy mix that's made when it comes to the accredited investor standard. And we all know what happened after that. The models were incorrect, the housing market boomed, you guys bought a bunch of our stuff, and there were lots of bailouts. All right. I'll fast forward to the more provocative, because I do know there are a couple of banking regulators here, and as a securities law professor, nothing makes me happier than to annoy banking regulators. All right. Our third little case study is going to involve payments. Payments. Oh, I see. Oh, look, I see the European Banking Association. Oh, this is great. Okay, so overseeing the payment system demands that regulators negotiate a complex interplay between innovation, inclusion, and market integrity. And diverging approaches between jurisdictions reflect the difficulties involved in building a framework for payments that is capable of responding rapidly to shifts in technology, while also being safe and accessible for all segments of the population. Now, needless to say, the payment system represents the backbone for an economy and its financial system. Being able to make and receive payments anchors economic arrangements, large and small, from neighborhood lemonade stands, e-commerce, financial firms sending billions of dollars to one another, to governments dispatching stimulus checks for those needing emergency assistance. Domestic monetary systems have innovated a variety of instruments to enable such transfers of value to take place. Cash, obviously, is the most ubiquitous and quintessential option, but there are others. In the US, for example, I'm going to save you how our payment system works. I made once a remark that got the attention of the US Treasury Department, where I said that the US payment system reminds you of JFK Airport. Old, slow, a little embarrassing, but yet the anchor of global commerce. Okay, most developed monetary systems are obviously the home of a variety of mechanisms and payment systems like checks, cards, wire transfers, recurring direct deposits, all that represent transfers of private money or money claims owned by private entities like a bank. And the US Treasury Department estimates there is at least $19.4 trillion in private money claims outstanding just within the United States. With digital forms of payment overtaking physical cash, however, in many countries, private money claims have become dominant in making payments. The proliferation of privately issued money claims means that assuring their absolute integrity is a matter of fundamental policy significance. If such claims are issued by shaky institutions, such that they cannot be relied on to pay out when required, then their capacity to create economic utility and confidence is diminished. In other words, they can't function as money properly. Now, this combination of payments as an arena of innovation, alongside the riskiness of private claims and the significance for payments to be broadly inclusive, as on the private side, someone told me, what is the most consumer-facing product in the world? I said, what? He said, money. We all know it. We all know what it is, even when we don't have it. Now, this combination of payments as an arena of innovation alongside the riskiness of private claims draws on and really raises the trade-offs in the trilemma and draws them into particularly sharp relief. When seeking to negotiate, US policymakers have favored securing innovation and protecting market integrity with resulting costs to financial inclusion at times. US regulation secures market integrity by relying on the highly regulated banking system to ensure that payments can finalize and can be settled properly, and also by connecting everyday people to the fullest functionalities of the payment system through reliance on bank deposits. At the level of infrastructure, the Federal Reserve offers accounts, so-called master accounts, at the Fed itself. For all practical purposes, they are most available to and usable by conventional depository institutions rather than non-bank firms like credit card issuers or money transmitters or fintech firms. Huge difference, by the way, with the Bank of England now in terms of its current policy. Indeed, even less traditional types of depository institutions, like those looking to provide services with the digital assets ecosystem, have struggled to qualify for Fed master accounts. Master accounts provide the gateway into the major settlement infrastructure undergirding the payment system. In the United States, it's called FedWire, where the Federal Reserve essentially moves money from one bank's master account to another's in order to settle up and finalize payments between them and, by extension, their customers. At the level of transactions, reliance on the banking system is further reinforced by the fact that banks enjoy unique authority to issue deposits, allowing people a place from which to make and receive payments. The combination of being able to offer deposits to customers and to also access the payment settlement infrastructure directly has meant that banks enjoy key advantages, such as ready-made customer networks, when innovating in payment services. It also means that any non-banks without master accounts developing innovations like digital wallets or peer-to-peer payment system services like Venmo or Cash App have to always engage with the banking infrastructure to ultimately ensure that payments can settle. This design broadly reflects a policy to forward innovation within the payment system in a way that emphasizes market and institutional stability. Regulated traditional banks constitute its foundation. They enable settlement to occur and directly work with the Federal Reserve to move money from one customer account to another. And importantly, they are also key issuers of private money claims to depositors. Federal deposit insurance protects bank deposits, such as when banks fail, which never happens, right? Money held in bank account is then backstop, and depositors have up to $250,000 guarantee for their bank accounts. And even if banks are themselves not innovating, non-bank payment providers still need to access the banking system to enable their payment products to be fully used. This approach to innovation offers assurance for regulators and consumers that can look to well-capitalized, regulated payment providers for recourse in case things go wrong. So now, all of the banking regulators, see, I was very, very nice there. For example, you have Zelle and different kinds of accounts, all where these kinds of the innovation that occurs always is one that has to operate in tandem with the well-capitalized, backstop, extremely well-supervised banks in the financial system. Now, this, however, does come with trade-offs. Again, along our little invisible triangle. And this emphasis on centering on the banking system within payments has certain costs for financial inclusion, which is, again, a little bit different from cash, right? When you think about cash as a physical bearer instrument that anyone can use, right? And it kind of flows, it's clunky, it's not that great. In the United States, there are literally airplanes full of cash that actually move cash from one place to the next. It has its physical limitations, but it is truly, let's call it the most sort of inclusive mode of money. This is a little bit different here with this particular format. Notably, millions in the United States remain unbanked and underbanked. Around 6 million households in the United States were unbanked in 2021. That's 4.5% of US households, such that no member of the household had an account at a bank or savings association. In addition, around 14.1% of US households were estimated to be underbanked in 2021. This means that though one member of the household had a bank account, the household still often used expensive non-bank payment services to meet their cash and liquidity needs. Demographically, the unbanked are more likely to be from lower income backgrounds, to be people of color, to come from single parent households. The rationales for remaining outside or peripheral to the banking system reflect the costs of banking, such as the need for minimum account balances, overdraft fees, and expenses that mean that just having to maintain a bank account can result in accumulating costs. Trust in banks can also be a factor that causes people to limit engagement. As such, the inability to access banking services means that millions of Americans and millions of people around the world, frankly, remain less able to participate in payments innovation. Indeed, even as the use of cash has waned, especially following the COVID-19 pandemic, cash use has remained relatively higher for communities of color and those in lower income households. In other words, people who are more likely to be unbanked or underbanked. Now, importantly, not all jurisdictions in the world weigh the policy poles of this trilemma in the same way. Others look to innovation and inclusion as guiding their objectives, even at risk to market integrity. The case of Brazil's Pix payment system is a case in point. Launched in 2020, the Pix payment system enables people to make rapid peer-to-peer payments from their phones without fees and with easy, low-fuss account setup. From the standpoint of infrastructure, Brazilian policymakers opened Pix up to both banks as well as non-bank payment providers in a bid to broaden customer adoption and to increase inclusion to those outside the traditional banking system, but using non-bank providers. And by every estimate, Pix has been a remarkable success thus far. In the course of just 1 year, between November 2020 to the final quarter of 2021, Pix was used to make 3.9 billion payments. Pix is being used by those from low income and underrepresented communities, including street vendors and the unhoused, to make and to receive payments. You could also think of other kinds of innovations where similar kinds of policy choices were made, like M-Pesa in Kenya and the like. Now, to be sure, as predicted by the trilemma, there are costs to market integrity. For one, real-time payment schemes are often subject to errors, fraud, and operational failures, owing to challenges such as large-scale use, high volumes, troves of consumer data, and difficulties involved in verifying transactions in real time. Policymakers also worry about operational security and data integrity. And these fragilities have required responses to addressing risks rising from widespread use and innovations in this new payments scheme. But again, different jurisdictions always have to navigate those three issues, and yet different jurisdictions come up with very different policies depending on the values of their home jurisdiction. But nonetheless, and I won't even get into the question of cross-border coordination, just sticking domestically, it can still be a very challenging role, a very challenging process of finding out how can you optimize very different policy goals. Okay, so how can you start to do so? And I tried to use sort of contemporary examples, but we could get super contemporary. Give me a couple of drinks. But if you want to talk about things like cryptocurrencies, or if you want to talk about things like artificial intelligence, each of these kinds of issues require sort of a calibration of not just risks and rewards, but really defining what those risks and what those rewards are, depending on what your national priorities are. And it's a little bit obviously easy for me as a law professor to sit around and looking towards the past at sort of these different challenges. But the role of the regulator is to actually have a forward-looking glance, to try to develop some kind of building block, some kind of architecture to prospectively optimize these very different goals for their constituents. Okay. Now, again, I do want to highlight that the regulatory mandates will help to guide this decision-making. And of the three mandates, again, of integrity, innovation, and inclusion, only integrity is truly a mainstream or a mainstay of regulatory agency mandates, both in the United States and the UK. As a Grundnorm of regulation, this is entirely understandable. However, the absence of financial inclusion as an explicit mandate creates a number of important challenges to regulators. First, in the absence of a requirement to consider it, financial regulators tasked with squelching out risk don't necessarily have the tools, flexibility, and in some instances, the bandwidth for evaluating how their decisions impact productive innovation and even less so financial inclusion, even as they are societally demanded and required to consider it. All too often, regulators are blind to how their activities might inadvertently risk increasing a country's wealth gap and it ends up obstructing pathways for middle-class people seeking to climb the economic ladder. And while market integrity too can be underemphasized or altogether ignored depending on who's in charge, it is difficult, if not impossible, to do so systematically without censure or worse, precisely because it is a formal requirement of the regulatory agency. Even deregulatory initiatives intended to loosen regulatory oversight are often at least pitched as friendly to investors and consumers. Meanwhile, the consideration of financial inclusion and opportunity for historically marginalized groups is largely up to the leadership of the agency, of any particular agency. But this leaves the issue entirely to the discretion of regulators who may find other mandates more to their personal liking or more politically rewarding for their future activities and ventures in government or in industry. So ignoring financial inclusion or the impact of a rulemaking on financial inclusion can have little to no political cost. Innovation itself can be subject to a similar risk, although there are certain kinds of market dynamics and pressures that can force a regulator to internalize much more so the costs of ignoring innovation. The absence of inclusion and innovation as mandates begs the question as to whether one or both should be more explicitly identified as formal objectives for financial agencies. In that way, regulators would be incented and at least formally required to consider trade-offs in policy where other mandates are pursued, including integrity. The argument goes that in the absence of an explicit mandate, there is no infrastructure with which regulators can identify or navigate trade-offs currently externalized to marginalized groups. The failure to consider inclusion and innovation as desirable regulatory outcomes results in enormous blind spots to policy and in important questions not being asked. Thus, explicitly elevating inclusion and innovation would, at least in theory, force regulators to, at a minimum, go through the procedural steps of considering other important policy objectives as well, particularly, again, policy objectives that have come to the fore more recently. Yet innovation and inclusion do not represent identical value propositions either, especially with one another or in the context of the inclusion, of the trilemma. Inclusion, for its part, offers a more compelling and less risky addition, perhaps, to regulatory mandates. one of the longstanding but hard realities of the US economy is that a key contributor to inequality is the massive under-participation of average and poorer Americans in the financial system. So people of color, the poor in particular, are less likely to own financial assets, have insurance, and own a home. So therefore, our wealth inequality just sort of compounds on itself. Financial inclusion, if made an explicit mandate or part of an agency's cost-benefit analysis, would help to empower regulators to deploy their administrative and supervisory tools in ways to break down long-standing barriers. In the case of, say, our capital markets regulator, the SEC, it would have to seriously consider the rise of retail investors, many of which are first-generation women and minority investors, as not only a source of risk, but also an opportunity to change the decades-long rise in wealth inequality. The OCC, our banking regulator, and the Federal Reserve would have to consider financial inclusion in their work relating to capital standards and the Community Reinvestment Act. So, for example, we had a regional banking crisis. You want to figure out, okay, do you want to saddle more banks with higher capital standards? What does that mean for the community banks, the smallest banks, the MDIs, minority depository institutions? What does that mean for those anchors to more vulnerable communities? And it also provides an opportunity to supplement efforts in the innovations field to experiment with new technologies and to launch pilots and programs designed to expand the credit box and drive more equitable solutions. Ultimately, when you think about these kinds of administrative steps, you have a series of options. On one hand, you can make more explicit some of the less explicit but incredibly important objectives of regulatory agency. Or, as an alternative, you can create administrative vehicles, administrative structures within the regulatory state to get the job done. Now, in the United States, as well as in the UK, we've seen that quite a bit when it comes to innovation, particularly. That you have offices of innovation that are designed largely as public-facing offices to engage industry and to talk to them about what they're doing, and when necessary, to introduce those members of the private sector to their contemporaries within the regulatory agency so as to speed and to facilitate their development. Now, interestingly enough, what you don't see in regulatory agencies, except for one agency, and my very, very good friend Mike Su, the acting comptroller of the currency, launched this after I started writing it, but before I published it. No, I'm just kidding. I didn't. But you know, what you don't necessarily see are offices of financial inclusion in agencies. Now, innovation and inclusion, as hopefully I've been able to demonstrate, are not the same thing, right? And they can have very different trade-offs, and they can have very different implications for both the market as well as for the economy and for regulators. Additionally, even if you were going to look at the innovation offices within these regulatory agencies, they don't necessarily have the stature to pursue those missions in ways that can potentially conflict with, or at least slow down, other kinds of offices that are existing within the regulatory agency. So, for example, when it comes to market integrity, pretty much every regulator in the world has an office of market integrity. It's called the enforcement office of that regulatory agency, right? But you don't necessarily have, again, the innovation office. There's certainly no inclusion office that has the stature to be able to participate in certain kinds of either rule-making opportunities ex ante, or even in terms of enforcement. Because enforcement itself can set precedent in ways that can have very important repercussions for what the law looks like. So you have a sort of a palette of different kinds of administrative reforms. Some of the hardest ones are to go through your legislature and to actually elevate things like financial inclusion and or innovation into the formal mandate of a regulatory agency. Some of the easier modes of getting this done would perhaps be to create an office of financial inclusion, but even there, I think that certain kinds of reforms could be useful. For example, making sure that the heads of those offices aren't necessarily fireable at will can at least, and given distinct terms, at least empowers them to pursue the mandate that's embedded in that particular mission, and to be a little bit more forceful about really helping an agency to evolve in ways to, again, at least consider some of the externalities of their actions. I have a whole entire kind of range of other theories that are not going to be in this paper, but are probably going to be even, hopefully this isn't too provocative, because I'm really trying to help regulatory agencies and some of my colleagues around the world to sort of think programmatically about, how do you build an agency in a world of change, but those administrative reforms are required in order, frankly, for regulators not to be shooting in the dark. And that's really what this paper is trying to get to. About 5 minutes over, which is remarkable, or I started 5 minutes late, I can't remember. But the last sort of point that I would emphasize, and that you'll see in the paper, and I really want to make it as part of the remarks, a regulatory agency is only as good as the information that it has. Now, it means in part, what kind of administrative structure are you building within the regulatory agency? And the details matter. But now, as I get old, when I go to regulatory agencies and I look around and I see, I look at them as young people nowadays, you see the importance of people as well. And if you don't have a broad swath of society participating in your regulatory agencies, you're also going to have blind spots. So the last part of the article is really ensuring that there's the human capital that's in your regulatory agency coming from as many different parts and diverse parts of the communities of any particular jurisdiction as possible, just to make sure that they're getting the data and the information they need in order to make good decisions. It literally is a process of ensuring rigor within the regulatory agency. And what we're seeing, particularly in times of heightened politics, is that not only is the administrative state not necessarily empowered with the administrative and bureaucratic tools to necessarily navigate solving a growing number of problems for which they are expected to provide solutions, but they also don't have the human capital to necessarily understand the repercussions of any particular rule on different parts of the economy. And I think that that's really an essential goal, that if you want to have more financially inclusive rules, you also have to have more inclusive agencies. It's an important start. That's it. Time for drinks.
Thank you, Chris. That was, a great lecture. But where were the sock puppets? We were promised sock puppets.
Don't tip me.
Look, I've got two very small duties to perform now. The first is more or less to declare the substantive part of proceedings at a close. Yeah. So from now on, it's frivolity to the end. All you need to know is the locus of that frivolity, yeah? So my suggestion is follow a local or somebody who looks local up to the 5th floor. If they give you strange looks then perhaps...
So you're doing it right.
And we've got drinks there and a cornucopia of other things awaiting you from now on. So that's one thing, frivolity starts now upstairs. The second, of course, is to thank Chris for a demonstrably excellent paper. I've got loads of questions to ask. Obviously, it's not the place for them in this context. Most of the questions relate, funnily enough, to this idea, this wonderful image of plane loads of cash money traveling across America. I'm never going to get that out of my head. What happens if they... Anyway, it doesn't matter. But yeah, there was an excellent paper, not just in its sort of detailed and vivid mapping of the financial regulatory space, of course, but also I just found this very, this sort of triangular framework of integrity, of innovation and inclusion, just really, really rich in many, many contexts, and certainly my own sort of in relation to the law and administrative state more broadly. So it's absolutely fantastic. So if you join me in thanking Chris one more time.